Hi, welcome to Remax Boulder Video Podcast. Today we have Trevor Bellows from Premier Lending, who has an office right at Remax Boulder to better serve our customers. One of the things that has come up in the marketplace in Boulder, since the market is so strong, it's pretty tough to get a contract accepted that is conditional upon another house selling. So Trevor's been with Premier Lending how many years, or how many years you been in the lending business?
3 years with Premier and 18 years.
18 years in the business. So we asked Trevor to come up with some ideas for our clients that if they want to make a non-contingent, as in non-contingent upon a house selling offer, what are the different ways that a buyer might be able to do that? So how many different ways could you do that, Trevor?
Well, there's lots of ways, but today I'm going to go over six of them.
All right.
Yeah, they're the most commonly used, but it's good to know. There's
Okay.
a lot of tricks, if you will, that we can do to ensure your purchase continues forward. So
Okay, well, let's talk about number one. Number one on your list was getting a bridge loan. So.
Bridge loan, yeah, probably the most common. People have heard of bridge loans for years and years. Bridge loan is where you pull the money out of your departure residence, use it as down payment into the new residence until you sell your departure. A lot of pros. It's very simple to do. However, it gets expensive. Bridge loans now are about one in cost of
Upfront
loan
fees.
balance. Yeah,
Okay,
yeah, they really are. So, and then there's also it creates another liability too that we have to take account for. In the debt to income ratio is something the lender is always looking at. And so then we have the departure residence liability, the bridge loan liability, and then the new mortgage on the new home. So
you got to qualify for all
They
that.
have to qualify for all that.
Right, okay.
Yeah.
Now, we were talking in many of our shows about the strength of the market. In the past, when the market wasn't so strong, did bridge loans go away, or were they still out there?
They were still out there, but they were really cheap. They were easy to do.
Even when the market was tougher? They were
Even
cheaper?
when the market was, yeah, when it was
Yeah.
tougher, Fannie Mae and Freddie Mac didn't require that we counted it in your debt to income ratio because it was understood that you were gonna get rid of that bridge loan. So
Okay, so now the rules are they have to count all that for qualifying. So as
Right.
far as that goes on the qualifying, what's the typical payment structure on a bridge loan?
yeah, typical is about like a second mortgage, a 5 to 6% interest rate range is where you're gonna find yourself, and it's
Okay.
interest only. So you multiply that percentage by the balance of the loan, divide by 12.
And those are monthly payments that are expected on a bridge loan?
Yep,
Okay.
exactly.
All right, and as far as when somebody gets a bridge loan in the process, when's the best time to do that? Because I know there's some rules about HELOCs and such, whether the place is listed or not. What's the rule with the bridge
Right.
loans?
Yeah, and we'll get into HELOC later, but as a bridge loan goes, it's fine, do it anytime you wanna do it because it's understood that your home, your departure home is listed for sale.
Okay, so that it's okay to have a sign in the yard and you run down to your banker and you've decided that you need a bridge loan. So when
Right.
somebody's working with you, Trevor, and they want to do a bridge loan, do you have resources for bridge loan, or do you just do the mortgage part?
We do, we have resources for all the bridge loans. Yep.
Okay, perfect. Right, should we go into number two, or is there anything else you want to mention on bridge loans?
Number two,
Okay.
yeah, we'll go on to number two, and that is to put a HELOC on your departure
And
home.
HELOC stands for what?
Home equity line of credit.
Okay,
Yeah, HELOC, second mortgage, second lien, all sorts of different lingo you want to use. Now, banks don't listen because they don't like to hear this sometimes, is if you do a home equity line of credit on your departure residence, before you list your home for sale, they're usually free.
okay,
Lots of banks are offering home equity lines of credit on your home for free. You
okay,
simply pay the monthly payments. And so it's a great way to access the money in your departure residence and use it as a down payment on the new home. But the bank, of course, doesn't want to know that you're going to sell that home.
right, so you don't want the sign in the yard, you don't want it listed when you apply for the HELOC.
Exactly, yeah, the title search will catch if it was listed, the appraiser would see if it was listed, any of those types of things, so therefore, to your point, yeah, you wanna make sure it's not listed
Okay.
until you put that on.
And you mentioned appraisals, what about for like backing up to bridge loan and HELOCs? Do the banks typically require an appraisal on the departure residence?
Yeah, so on the bridge loan, that's
Mhm.
another one of your expenses. On a home equity line of credit, a lot of banks are gonna just go ahead and take care of it for free.
Okay,
Yeah.
all right. So any other thoughts on the HELOC process?
No, I really like those. Well, I will add one other thought, is especially for new construction. If the the new home that you are buying
Mhm.
is new construction, then you have plenty of time to get a home equity line.
For
of
like a
credit.
dirt start.
Yeah, yeah,
okay.
you have plenty of time. So HELOC is good if you have lots of time.
Okay, fantastic. And then this thing called the 80-10-10, why don't you explain what 80-10-10 is and how set in stone those numbers are, if you will?
Yeah, you bet. So 80-10-10, another lingo. What that means is if you're gonna buy your new home with an 80% first mortgage, a 10% second mortgage, and then 10% down, that's the 80-10-10. So what this does is it allows you to buy it for just 10% down. This method assumes that you have 10% of your own funds to pay 10% on the new home, and then you can configure it actually however you'd like. One of the examples I have here is a 57-33-10. 57% first, 33% second, 10% down. Then, once you sell the departure home, just pay that second mortgage off.
Pay the second off and then you're just left with the first mortgage payment. So-
Right, and set your first just where you want it,
Right.
structure it just as you would if you had already sold your departure residence.
And then kind of the, not really negative, but one of the things you have to consider is that you still have to qualify for the new first, the new second, and the old mortgage, right?
Right, exactly right. So same thing with the other two options, is you would need to
Right,
qualify.
so it does give you a lot of flexibility so that at least when your old house sells, you can just have that payment that you want.
Right.
So,
And another nice thing about it is once you move into your new home, you pay off that home equity line of
Right.
credit or whatever that second mortgage might be, you can reaccess it.
Okay, perfect.
If you needed to go do a kitchen renovation or something like that.
Okay. Number 4 that you had on the list was a recast. What's a
Recast.
recast? Sounds like something else you learned to letting after you broke your old cast or something.
Yeah.
So-
Recast is my favorite. What a recast is it's taking an amortized loan, sending a chunk of money towards that loan, and having that bank or that investor recast or reset your loan without doing a refi. So for example,
And this is on the old property, right?
no, this is on the new.
Oh, okay.
So you buy your new property, say you have 500,000 purchase price, 400,000 loan, but once you sell your home, you really only want a $200,000 loan. All right, well, you still do a $400,000 first mortgage.
Gotcha,
You
gotcha.
come to closing with your 100,000 down, and then once you sell your home, you can call that investor and say, I have a chunk of money, I'd like to send it in, recast my payment, and then your payment will drop without doing a refi.
And how many lenders do that? Because I don't think very many people know about that option.
Yeah, and most investors will offer it, they don't advertise it though, because of course they want to make more interest.
Right,
if
keep
they
the
can.
loan out there.
Right, but they'll charge a fee, $250 to $300, and they'll usually require at least 10% of your balance.
And does it start over with a new 30-year M or the number of years or months left that,
Right.
but
That's-
a new balance?
Right, that's why I like it. So say it takes a year for whatever reason to sell your departure residence and get that chunk of money, you recast and you only have 29 years left on your
And
mortgage.
same interest rate.
Yep, same rate, same configuration.
Okay, so when somebody's shopping for a loan, is that a smart question to ask their mortgage broker that they're working with? Is this loan recastable?
Yeah, it is. I mean, it's nice to be able to send in a chunk at any time that you really like
Right.
to. Sometimes people just want that option. They think they're gonna put a lot of money down, and then their financial advisor gets involved and says, well, wait a minute, before
Right.
you send that in, maybe we should invest. So it really leaves your options open once you've closed on your departure residence.
It'll let you lower that payment when you have that money available.
Right.
What about, just as a side note on the recast, what about interest-only loans? Did those disappear? Because those were the type of thing too, where you pay down a bunch of money, then your payment would lower the next month. But those are pretty hard to find these days, right?
They're pretty rare. The home equity line of credit, second
Mhm.
mortgage is a HELOC, or is interest only. There are some ARMs out there still, 5 and 7 year ARMs that are interest only,
Really?
but they're still a little bit dangerous. We're still a little gun shy of those.
And one question I didn't ask you about, like on HELOCs, those are usually variable rates, right? They're not usually fixed rates.
Right,
So that's something for people to keep in mind.
yeah, and the interest rate can change monthly, not annually like
Right.
an ARM.
Okay, all right, next one is number 5, I think we're on, and that's essentially utilizing your retirement plans, maybe like your 401k to borrow against that for your down payment.
Yeah, it's always a great thing to take a look into. The 401k, most 401ks will have a process that you can borrow against it. It doesn't typically cost much money to access it, and you get 60 days with that money before you have to pay any taxes on it. So if it's used to buy a primary residence, you can do that. Or you could set up a loan within your 401k. You could borrow $100,000 from your 401k. You'll have a loan that you're actually repaying, but we don't have to calculate it on the lender side in the debt to income ratio.
Really?
No,
Okay,
because it's your own money,
as
so.
opposed to like a HELOC or a bridge loan, you have to calculate that
Right.
payment in the qualifying ratios.
Exactly, so
Okay,
if you
perfect.
defaulted on your 401k loan, that's your own money that
Right.
you're not paying yourself.
Okay,
So, very good option, helps keep the debt to income ratio down, and it's got repayment options. Typically with most 401ks, it's easy.
is there any considerations if somebody is gonna access their 401k as far as length of time it might take the money to get out of there, or is it pretty much a phone call saying, send me the money, or is there any delay factor in there?
Yeah, good point you bring up. You'll want to check with your financial advisor. I've seen some be able to access it in 2 days.
Right.
I've seen some take weeks.
Yeah, it comes to mind because, I had people thinking they could get it with a phone
Right.
call, and then you're set to close, and they
Oh.
couldn't, so, yeah, always good to check out, so.
Yeah.
Okay, number 6 on your list is
Last one.
rich uncle, huh?
Yeah, rich uncle, there you go. Is a gift.
Yeah,
Gift money is very easy to obtain, of course. The paper trail is very limited on it. It's free, obviously, to receive that money. You don't have, you don't set up something with
Right.
your rich uncle. The one thing to caution people on though is the gift requires a gift letter you sign that states, I'm not required to repay this
gift.
gift.
It's not a
Gift,
loan, right?
it's not a loan.
If it's a
This
loan, you
gift,
had to pay
right.
it back.
I'm not required to repay this, yeah, exactly. So you do want to watch that, we will paper trail it, and then you'll want to talk to your accountant if there's any tax implications, especially for the donor.
Okay,
We don't report as a lender, we don't report gifts, but just in case they'll still want to check.
okay, fantastic. Any other thoughts on that one?
No, that's probably the easiest one,
Okay,
if
well,
you do have that rich uncle.
that's a lot of good ideas, so Trevor, why don't you share your contact information if somebody wants to call you and brainstorm a little bit on how they can write that non-contingent offer, how they get a hold of you?
Sure, Trevor Bellows with Premier Lending, and I'm at 303-748-9990 or trevorbellows.com.
Okay, thank you, Trevor,
All right.
appreciate it. Dwayne Duggan of Remax of Boulder, Remax of Boulder Podcast, signing off.